Pickelonia.
Good morning. How's everyone doing today? I did not enjoy my Friday off stream, C-Mill, unfortunately. I had a doctor's appointment. I have to go in for like my yearly checkup or whatever for my insurance. And they submitted all the tests to the lab to like clear it. And then they got back the wrong results, and then the lab was closed. So I have to go back again tomorrow morning at 8:30, and hopefully I'm back in time for market open. If not, I'm gonna be like a couple hours late. But yeah, it was a miserable day. Thankfully, I got to sit in the waiting room and make money because SPX rocketed. So that was nice. John Smallberries, welcome to Cornishon. Thank you so much, man. Good morning, and thanks for taking some time to answer questions. No problem, Army Vet. What reason would ETFs have delayed buying back Upstart shares? I'm assuming the holidays, but I would have thought they wouldn't care. About that sort of stuff, it seems like the shorts were expecting it and didn't get it yet. I'm just trying to wrap around my head around the delay. Possibly they wanted a cheaper entry on their shares. I think the shorts were prepared for a delay into December OPEX. That's when we first saw them position for long vol, especially on Upstart here. And so, we see the short positioning move out for long volatility. Everything gets rolled from synthetic short to, synthetic long or long in the money straddles. And, then we see nothing, right? We just see continued shorting. I think what happened here is, and it's possible, the shorts weren't aware either that the ETFs could further stall the settlement. But if you think about these settlements, they're actually multifaceted, right? You have the shorts returning cash to the ETFs, right, or the APs. Let's not say the shorts, because the APs can act on behalf of the shorts, and this is probably better terminology. So you have the APs returning cash to the ETF, right? Now this can get delayed, and the APs know it can, right? And so they're prepared for one deferral into the next period, which would be November to December, right? But then when the ETF goes to buy these shares, they have, their futures settlement on quad witching, which was December 16th. And we see a bunch of ETFs get prepped for this. They sell off shares, they start to rebalance. But S&P's ETFs don't rebalance till after. Not all ETFs rebalance quarterly. There's a lot of variation here, but basically, the rebalance occurs the week following the OPEX expiration, right? So this is where forwards are closed. and counterparty settlement would be due, right? Except counterparty settlement isn't due because there's another holiday. And this is a different trade. So this trade is new. This trade is old and can no longer be deferred. So the ETFs get the cash, but they don't have to spend it. Now the ETFs get another delay until they have to rebalance and repurchase shares. And until then, their book is balanced, which is all the ETFs care about. And that puts us into that Jan 12th through 18th period. Now, there's a few advantages here for the ETF. One, they don't have to buy shares at a loss until the new year, so they got to put they got to push those shares out. If the shares are cheaper at the point that they begin their rebalance, even better, right? And they get to hold that cash that they got from the APs for almost an entire month. I mean, a 4-week period. There's several instruments you could use at a risk-free rate, even. Um, that you can just make money on that money by holding it during that time frame. So I don't think you need to search so much for an advantage for them to do it, but just any motive, right? And I think there's plenty of motive there. Oh yeah, I feel fine. I got like a little under the weather like Friday, but I think that was just kind of like the antivirals wearing off and stuff. But I feel better today. Will the colonoscopy video be available immediately? To be available to Dillionaires? We'll see. My doctor doesn't really care about the vaping. He doesn't think it's that bad. Maybe I should probably find a new doctor. Could you please walk us through how to check historic IV for price specific options contracts? Good luck. I don't think you're gonna find that information really anywhere. Maybe Fidelity would have it. That's the only one I can think of. Market Chameleon just has HV for the underlying, and it's kind of inaccurate. Their calculation isn't very good. Bots is rebalanced every year. Um, but you still can't hold forward contracts for that period of time. Those single stock futures and forwards, those are quarterly contracts. So the rebalance doesn't matter so much as the settlement of those contracts. XRT went negative net cash again on Jan 5th. Okay. XRT's been pretty weird since like December 18th or December 16th. It doesn't hurt when I urinate. Thank you for asking though, Nostradamus. Appreciate you guys. So that's how the ETS can pass their audits despite not having the shares yet. Do they only care about the NAV, not the balance? Yep. They only give a shit about the NAV. All that matters is NAV. That's all the SEC gives a shit about too. I mean, if you could go back and read GME's report from January 2021 from the SEC, and they were like, well, XRT had all this fund flow and it was like one of the largest buyers of GME during this period, but their NAV was fine, so that looks cool. What happens to this deferment theory if we have no price action through the Jan rebalance OPEX? Sit and wait for a mean liquidity reversion to sell CCs. Yeah, basically. Is this the Wombo combo that DFE tweeted about? Deferral into deferral for stacked obligations. I don't want to keep bringing up the DFE tweet because it draws away from the data that we have that supports the theory. And people just focus on that because, well, either dumb or mostly dumb. But yeah, I mean, there's some interesting points in DFV's tweets around that time frame when he bought Jan 15 options, why he kept Jan 15 options into expiration. Um, but you know, none of that's confirmable, right? So it's better to just focus on the data we have and, you know, look at what the data points to and the correlations in the data with these deferral periods, which are strong and consistent. So if they care about NAV, does that mean they're going to buy more shares when it comes time because of the lower prices? Not necessarily. They might have to buy fewer shares because of the lower prices. Remember that weighting in the ETF is reduced when the price drops as well. You guys were investigating bullish things Thursday night, I think. Did you did it give you more insight for the 12th to 18th? Oh, yeah, we were kind of talking about uh the lack of variance in XRT um against their NAV, which seems to have died off since December 16th. Turd found that out by going back and going through the ETF historical data, and we were kind of trying to see how that lined up with the data that we had and if it was pointing at the same thing. There are some correlations between the two data sets, but I don't know if there's anything that we can confirm there. For people with high cost basis, do they need to take the risk of selling CCs now or keep waiting for a liquidity event? I mean, the profitability of covered calls during a liquidity event is extremely high, right? Uh, Probably far more than you would make taking risk every week with your shareholding. But I can understand if during certain periods of the month or away from deferral and OPEC states, people with smaller positions wanted to take risk in selling CCs. It's not so bad. It's just not great. Hi, Gerg. Long time no see. Where's Trash Dan? Around. Also, could you give a 30-second up to speed for pours? Poor enough to not get options like yours truly. Um, we're expecting some sort of price action on GME between the 12th and 18th due to FINRA deferrals. And that's at least our current thesis on why we're not seeing a reversion in the liquidity of GME. If GME persists in being illiquid after that point, I would continue waiting on a reversion in liquidity. Liquidity is mean reverting, and so at some point, synthetic shorting has to capitulate. It is not a persistent position. If we do have a true deferred Jan OPEX, which OPEX should we closely compare it to? Since the only other one was the sneeze. That's not true. If we have a deferred OPEX, March was also one. And positioning may not be as exaggerated as it was even then, right? So it could be smaller than March, but like bigger than May or August. Yeah, we could definitely talk about the SPX a little bit. So give me 1 second. Let me this pulled up. So we came right within my upper range on Friday for long calls, very very close to testing the upper boundary that I had set for next week here. Wish that was a little tighter. Hold on. There we go. We did, however, fall through the bottom of the put side. I was unprepared for another test of the trend line here. We have like a quadruple bottom and a pretty strong bounce. We have almost enough time since our last peak to start seeing the effects of another bear rally, or we do have longer dated puts were expiring last week. So we're approaching more longer dated puts expiring here in January. We still haven't dropped in price sufficiently to put those in the money. So shorts are, losing leverage in an environment where puts continue to be overpriced because of the volatility. I would say that this very much looks like it can continue into next week. I think we might see a bullish reaction from the market leading into CPI and PPI, some of which obviously was felt on Friday. We, I think the expectation market wide is for those data points to continue cooling. And if inflation continues to cool and labor markets continue to maintain their strength, there is some weight to, what Jay Fresh was talking about the other week, where, when do we accept that this is just the new normal? That we have a reduced pool of labor to draw from since the pandemic, lots of early retirement, deaths, people moving to work from home, people moving into their own small businesses, and with that reduction in available employees, that's going to naturally create demand in the labor market anyway. We're not seeing wages grow significantly, so that's not, creating a detrimental effect. We are going to see contraction in margins. That will weaken the labor market in time, due to the increased interest rates. But maybe I'm getting a little too far ahead of myself going into that. That's, going to be further out this year. But right now, yeah, I would say that this run looks pretty strong. It looks like it can sustain. I think the next level of consideration would be like 39.65. I've talked for some time that I was targeting upside between 39.20 and 39.65. It looks like 39.20 is going to be good. Obviously, the political climate remains really volatile, and that presents a significant degree of risk. So be careful. You don't have to use this run to position on the long side. You can try to just use it advantageously to position to the short side for further out. I don't think the Fed is going to shift course just yet. So enjoy it while it lasts, I would say. And then if it lasts too long, maybe it's time to reconsider the macro environment. The banks are still okay. And, at some point, the Fed is going to take away their overnight RRP. And that's a lot of capital that can come flooding back into the market. A few months ago, you were exploring another stock. I think it was not Upstart. You were looking into it. And now that we're past it, could you let us know what you were looking at? Oh shit, what was that called? It was like FFIE or something. Yeah, it was this company. They were just like bankrupt and shitty and going out of business. Um, and they actually, I think they ran. I think this run was after we were talking about it in August. And then we just, I don't know. It didn't look attractive. They have some serious financial problems. Ultimately, I never invested any money in it. But it had some interesting stuff going on. Is Jork's indicator still pointing towards a return of liquidity on GMA? Yeah, the tips have peaked. Actually, if you give me a second, hold on, I can pull things up. Probably good to have this up for the rest of the stream anyway. So it does look like we've kind of topped out on their available liquidity. With Friday's price action starting to return some liquidity, that's a good sign. But we could still be several days out from a reversion. Remember that these crossovers don't run necessarily right away. They can take some time. In March, it was a few days before we saw any price action. We're still fairly far from a full reversion, so it could be like 5 or 6 trading days away still. It could happen more sharply, like it did in May. If you look at the May run, like the reversion here. Happened very rapidly. Obviously, this is Tuesday the 24th, and we started running on Wednesday, so um, it can happen quickly. But March was much more drawn out and methodical in its both its run and its subsequent shorting. I think SPX will have some T+2 GEX from Friday, so long as there's no reversion on Monday. Possibly. Yeah, or we revert to mean on Monday and then nothing gets covered on Tuesday. We'll see. It was a big run, so the weight of the gamma exposure and the hedging should be pretty big, I think. Not a big expiration though, so no, not too much on that front. Which may be good. That means that, fewer options would have sold off. If the VIVIX is at 2014 lows, is it worth it to go long on the VIX or not yet? I mean I am, but very carefully. I'm not out of the money long on the VIX. I would say that it's likely we see an increased volatility environment before we see a significant cooling in the VIX. And by significant, I mean like I don't think we're going under 15 anytime soon, but we might get close to 15 before we see any significant downside because, well, frankly, shorts can't really reposition at these prices as we've seen over the last several months. So I think in order for us to see any significant buildup of short side interest on, SPX or long side interest on the VIX, we're going to need the prices to drop. But if we do see that, I think then we'll probably see another spike in market wide volatility for a period of time. Do you think this might be the biggest Jumio picks yet? No. I think it'd probably be smaller than January and smaller than March. The same levels of interest simply aren't there. So, um, you know, obviously they initiate the run, but it's retail that propagates the run and continues it. So, um, yeah, I don't think it'd be as big as even March. But it could still be big. I mean, it could still be, 100, 120%, maybe more. Potentially. I mean, based off that historical data. Because repeating back is a way to improve understanding. Mean reversion. Something's happening Jan 12th through 18th. If not, that is deferred to a later date. No, the settlement should not be deferred. I know there's a holiday during that period, but there's no other step of the process to defer, and you can't defer something that's already been deferred that's due to settle. Only new settlement due during that holiday period should be deferrable. And since there's no new settlement that we care about during that period, we shouldn't have to, that shouldn't be a concern, at least with our current thesis. So does that mean that it changed the previous macro projections we talked about a while back? Regardless of what the Fed does, when earnings comes in Jan and April, it will severely impact SPX negatively and drop it down to 3,400 or lower. I mean, unless the Fed starts pulling back interest rates, yeah, I think we're going to still see a continued collapse of like gross margin across, you know, several assets which are still trading at overly inflated PE ratios. So I'm not particularly worried about quarter 4 and quarter 1 earnings doing some serious damage to equities. I think it's going to be too soon for them to reduce costs, um, and you know, turn those revenues around. And once, you know, once we're starting to report year over year and that trailing 12 months drops off, it's going to get bad for a lot of the big companies in S&P 500. Sorry, I just want to make sure I don't miss anything. Not everyone's tagging me. Spy Mirror SPX, not entirely, but close. It's very close, but there is some arbitrage between the two. Sometimes it's quite wide. You do Tesla. Yeah, we can look at Tesla real quick. Tesla continued to bounce on Friday. You know, this is kind of consolidating on this longer term trend that I have here. I still think while the short position's starting to take profits, I still think Tesla's pretty grossly oversold at this point, and I would caution playing the downside until there's some significant reversion. I know there's bad news, but you know, over the weekend, but that bad news may just lead to it dropping back to the trend, and then we still have the same issue with it being fairly oversold. So if you want to play the downside of Tesla, it might take some time. You could probably enter at a higher price. If you want to play the upside, there's some risk. I'm not particularly attracted to playing it at all right now. I think the stock's worth about like $45 to $65. At least I wouldn't buy it unless it was that price. But it's going to be volatile here while it's oversold, and so it's risky. Um, if it drops enough, shorts are going to want to take profits. If it rises too much, people are going to want to short again. If two's the max, can you talk about the level of confidence? And there only being two trades, versus 3 or 4. I mean, it's three trades, right? It's cash to the ETF. Well, it's two deferrals. Yeah, so you have three trades. You have the cash to the ETF rebalance, the ETF buying back in. But yeah, I don't see how there could be cause for a third deferral in that process unless they were unable to buy the underlying, which I don't think there's a case to be made as far as like GME like liquidity goes. It's illiquid as all hell, but if you bought 1 million shares at market, you'd fill, right? And when you try to make the case for the security can't be bought, you have to prove it every day, and that's impossible, I think, on GameStop. That's more something that applies to like OTC stocks or you know, stuff that's delisted or bankrupt. It definitely doesn't apply to anything trading on NYSE because they have minimum liquidity requirements, right? Jan OPEX action is likely deferred until Feb due to MLK. Actually, no. The MLK deferral dates are the 10th through the 13th. These are the dates that are deferred, and none of these fall within the January's OPEC settlement. January OPEC settlement would be from the 20th through the 25th. This year, holidays shouldn't be as aligned, and we should have a more regular schedule of these if this continues. And that's gonna, those holidays shift one day every year, right? And so it moves around the deferrals that we'll see. If we're correct about the deferral theory. Right now we don't know, it's untested. This is new. Yeah, FFIE bankrupt, failing to file with the SEC, likely to be delisted. Yeah, there was a lot of bankruptcy risk there. I mentioned it once on the Discord about 6 months ago, I think. I think that was around the time that we looked at it. I think you brought it up and we looked at it and we were like, oh, wow, this is crazy. And then it ran really hard, and then we just stayed the fuck away from it. Once it gets a delisting hearing, we should all full port into it. What's up, Buckled Up Jan? Everyone say hi to Buckled Up Jan. There's a lot of momentum indicators you can use. They're not going to be as good as mine, but you can use like Stotch or ADX or DMI. Well, just DMI. You can use like, you can use RSI. It's not my favorite, but you can use MACD. May was odd. Do you think Jimmy's next earnings should be? We'll see. There's the potential for it. Do you think playing the down day in between the first OPEX peak and the T+2 high is too risky, foolish? That depends on how hard it runs and how many strikes go in the money. Sell in the money CCs on the first peak, close next day, then reopen deep in the money CCs T+2. Very risky. I don't know what else to say about that. It's risky. You're betting on a lot of unknown information. Although the historical data is consistent on significant runs, creating continued momentum to the upside. Uh, not not all of it does that, right? We have November and May as examples of, where that wasn't necessarily realized to the degree we would have liked. Or not May, sorry, June. Also the August run, the second part of the run, the risk off, didn't lead to very significant T+2 price action. It did on Bobby, but it didn't on GME. Since you were here Friday, I have to ask, how was Ape Fest? I didn't go. Did you get your own booth and sign autographs? No. Did they actually do that? Which is the most potential for the largest, most violent move between GME and Upstart? Options if there is an OPEX. Upstart has a smaller float and it's less liquid. Can you talk about fail to volume developments on Upstart? Looking at Jan runs still. Yeah, I mean, I'm still looking at January for any kind of effect on Upstart. I think it's going to be in line with GameStop. I think the correlation over the last several months between the liquidity levels on both of them are much more in line as more and more volatility shorting came in on Upstart. Upstart has a significantly lower float and far less secondary market liquidity than GME does, which means it's closer to something like Sava or Revlon, where it has these really high failure rates because of the lack of secondary market liquidity, right? And then also the potential for implied volatility is much higher because it is less liquid, right? Remember, the less, if you read River Runs Dry, the less liquid the environment, the more volume to resolve the liquidity. So if you need liquidity in a very very illiquid environment, you need more volume to get it, and more volume generates more implied volatility. Now, don't get me wrong, GME's relative liquidity is kind of its own beast due to the DRS, DRS decreasing the size of the tradable market. There's other factors with GME. So GME also has a lot of potential. It also has FOMO, which is something Upstart doesn't truly have. And so, Upstart, with lacking those other 2 points, may have equivalent implied volatility moves to GME. It could be significantly greater, but that would depend on long short capitulation, which we may not get enough of a run to see. Tesla short strangles might be a little less risky. Maybe. Yeah, big margin cost on those though. So I would say that a lot of people might not be able to do them. If someone is good at day trading momentum and breakouts on SPX, so that skill carry over to day trading other tickers. Not necessarily. Momentum on SPX is strange, and it comes in kind of violent moves. It's SPX trading is more about positioning than it is tracking momentum and understanding market maker hedge and interest levels. Other stocks probably benefit far more from surges in momentum as it tends to continue. Whereas, momentum on SPX can turn on a dime and move the other way. Sorry, one second. Let me catch that Ko-Fi you just sent. Missed it. So Gen 24 510 gang for Upstart as an IV play. Awesome. Yeah, I have a lot of those. I'd be interested. The Vega right now on them obviously quite low, but it could get better. Especially if the price moves up quickly or significantly. They're very cheap. I don't know if 510 is really the right strike to buy. I bought it as a meme, but there's probably strikes with better spreads. Wouldn't selling CSPs on Tesla not be a bad play for Tesla? The IV is very high in holding. The ETF wouldn't be a bad long-term play. You could. The Tesla short ETF. Yeah, you could. High volume in the consolidation period on Tesla. What does that imply? Buying. Yeah. Remember, so if you have a short position that's, on a stock that's oversold, they're going to be they're future buyers, right? They're buying back, and so that drives up volume at the bottom. Because they're closing shorts, they're very profitable. A couple of June puts or SPX, and they thought they should be printing big in the near future, but if it drags out too long without the next leg down, it might lose too much theta. Yeah, it's any long-term positions on SPX need to be actively managed. So you need to roll them, you need to move them, you need to position them advantageously when you get the opportunity. And you definitely don't let positions on SPX sit through profitability unless you fall like deep into the money suddenly. Um, you can always take profits and reposition because you're dealing with a very long time frame, right? Are you gonna tell everyone why not to enter EPAM yet? I mean, we don't really talk about EPAM a lot because it's too expensive and the options market is fairly slim. EPAM can pull back to like 300, but if Nasdaq continues to move up, I'm pretty sure that EPAM will pull up with it. It's very illiquid, also, very high ownership, very small float. There is no options market here though, so it's most of your profitability is going to have to come from shares, which makes the amount of capital you have to invest pretty intense. I think these prices on EPAM are really good. I think lower as possible, but the company makes an obscene amount of money. Their revenues are amazing. They have pretty low overhead and fairly low debt. We assume we would start running the deferral on Jan 12th. Isn't MLK holiday covers the new deferral period starting from 10th to 13th, which would further defer again to Feb? No. It could defer any obligations due during the 10th to 13th, but it doesn't defer obligations that have been deferred to that period. So you can't triple stamp a double stamp. And that's why breaking down these trades was such a revelation, if you will. I don't even really want to think about it. Just missing link was because these trades are multifaceted, and that allows propagation of deferral periods to continue over a period of time. Whereas you can't defer something into a deferral and then defer it again, right? High volume in the consolidation period on Tesla. What does that? Okay. I took my original investment out of ENVX last week, but my calls went up 110%. Nice, you caught the bounce. And I only have house money in on it. How high do you think oversold bounce may go in the next week or two? That was ENVX, right? I don't know. It could fill the gap. Maybe 960. Um, I don't know if it'll fill the whole gap up to 12. I kind of doubt it. But I also don't know what news caused this, or I forget what news caused it. I think you told me before, but I don't remember. Um, but yeah, I mean, I could see this continuing back up to like the 950 range. So you might have another $1.50 of upside. It's at resistance right now. So your risk would be really tight around like 780. Um, and then obviously, if you can break that midpoint there, what is that? Right around 892, then the chances of 950 are pretty high. If it breaks 950, obviously you could continue to follow it up to like 1050. If it breaks 1050, then you can move up your PT to like 12. But I would be very cautious with it given the size of the sell off. I highly doubt it reverts all the way back to its previous price. Which potential for the largest is violent move between Jumia and Upstart options? If there's an OPEX, okay, cover that. Hold on. I'm pretty far behind, so I'm just trying to catch up here. Are you going to tell everyone why not to enter EPAM? You'll be selling CCs on your oil stock before quarter four, quarter one earnings drop in the market. I've been selling weekly and longer CCs on ZOMs when appropriate. Time to time the top for in the money CCs before SPX drop. Thanks. I don't have any out on Oxy right now or BP, but yeah, I think if the SPX rallies decently, I'll sell some, probably in the money, on a pullback. Um, we are getting close to when around the period where I think we could start to see oil rise, but I'm still kind of targeting mid Feb to late March for seeing that happen. So I have been selling CCs on Oxy for a while now. I just don't have any out right now. The ones I had out expired Friday. If Upstart runs hard tomorrow, you're taking profits and repositioning the following day before T plus two. Probably not. That would depend on how hard it runs. For the ETF FTDs, I assume you're referring to. The next ETF FTD runs on like the 17th. So Yeah, I'd probably just take profits. I mean, I don't know how hard it's gonna run. Last time we moved from like 12 to 14. This is not quite double the amount of FTDs. That's like, you know, 3/4 more. So yeah, I mean, I'll target a shorter window. I'll probably play some weeklies on it and see how it goes. And then yeah, I'm not really concerned with T+2 having any effect. ETF FTDs create liquidity, which generally leads to shorting. So a return to spot is very likely. Right. So ETF FTDs are covered. Price goes up. Right. That creates liquidity at the top, which allows them to short back to spot before T+2. Right. And then if it's back at spot on T+2, there's no T+2 carryover on the market maker side. So there's no obligation to be covered here. You can just trade flat. This week for Upstart, Jimmy. Monday seems spicy for Upstart potential, but then Tuesday seems more low key. I need to travel during one day this week. Tuesday safe for travel. I have no idea, man. I mean, it might be a better bet than tomorrow, at least as far as Upstart's concerned. An EPM recruiter approached me recently. I put out some feelers and found out they lowball their tech talent a lot. It's possible. That doesn't mean you can't get more out of them just because they don't offer a lot right away. Mind Swap, welcome to Dillionaire. Thank you so much, man. Hit me up on the Discord, and I'll get you added to the country club after the stream, man.
Yeah. Yeah, we might have a chance, but we ain't got ropes. Give us more than a chance, cause we ain't
Is rolling Fubo Jan calls out worth it to give it some more time? Sure. I mean, probably, it depends. I don't know what's left of those. Probably not a lot of money. Could, I guess. Is it possible SPX to drop back down to 3,800 in the next week or two? Still have the losing side of a strangle. Average down, but debating whether to cut or roll up as a hedge. Generally, on a big move like that, I'll cut it pretty quick once the move is confirmed, and then I'll reposition it as a hedge as we move higher. That's probably the best way to handle that, unless you have a ton of theta on the short leg, which I doubt you do. I also, on big confirmed moves like Friday, I also tend to buy more calls as it moves up into the call side of the straddle, because you get a lot more flexibility with your profits to continue leveraging up. But yeah, I mean, CPI or PPI could be bad. We have a Fed rate decision. Well, that's towards the end of the month, though. But without PPI and CPI being bad, no, I don't see a lot of potential for downside. Although, you know, any crazy news could come in and drop it again. It does look like a strong bounce, though, and it's now moved up into a range where there is almost no short positioning. So shorts will need to reposition. That might be your best bet for a pullback of any sort. Anything new on Fubo? I think they raised prices on some of their subscription packages recently. I know they lost a couple of their content providers, but then they picked up Bally. But not a lot of change. I mean, I don't think there's any significant change to their profitability projections. My weakest ability is after taking profits on an OPEX run, repositioning with long calls. Do you typically wait until the next day, or just look for a specific thing on a pullback? Hard to ask. I generally don't play both. I just sell like half my calls on the first one and wait. Um, I mean, I'll trade like intraday volatility on them and stuff with weeklies, but that's just scalping at that point, right? You can't master trading Tesla. It's far too, even nowadays, it's far too volatile. SPX is significantly less volatile than Tesla. So no, I don't think they're related at all. I don't think if you master one, you can master the other. They're very, very different. I mean, Tesla has, you generally speaking, 2 to 3 times the volatility of SPX on any given day. Depending on how low GME and Upstart could potentially get before this anticipated squart. Well, I mean, GME is also clearing ETF FTD, so it's getting a little bit of liquidity every day. Unfortunately, with increased interest at these prices, which there is, people are more interested in calls. They're cheap. That makes it more and more difficult for them to use that liquidity effectively. So, have we seen our low? Probably. But there's still some potential that they can continue shorting. They do have a few more days before we expect them to have to cover anything of note. Depending on how GME, I'm sorry. I have some 17 CSPs out on GME expiring this Friday that wouldn't mind getting assigned on. Just wondering where you saw possible price action for the upcoming week. I mean, the 12th through 18th is the period we're looking for this potentially deferred OPEX covering. So if we start to run, then you're unlikely to get assigned at $17. I mean, we're only $1 away from that right now. You could roll them up for additional credit and buy at a higher price, but with relatively the same cost basis. Provided the underlying moves up, obviously. You could roll them back into the money. That's an option. So if you're like 17 moves out of the money, right? And say it moves up to 21 by like Friday, you can roll this up to like 21.50 or whatever. And still get assigned, but you know, the net credit from the roll is going to give you a cost basis around like, this is just an estimate, but around like 17.50, you know. Oh, actually less because you have the credit from the initial CSP as well. Some longs on Upstart selling Jan 1250p, buying Feb 2250C. Thoughts? Short dated for a synthetic long. Generally, you want those to be very far dated foundation. If we look back on Jan 21, because you want that Vega exposure, that helps your profitability a lot. If we look back on Jan 21 until now, we've never stayed flat without a run for more than 3 months. And I mean, after hours runs included. And I feel like we might repeat similar past year's chart again. I mean, there is a repetition to all of this. That's kind of the idea. And um, in the next 2 years or so, with this new 100-week lows, possibly. We should have more consistency with OPEX runs this year. I was looking out at the holiday extensions, and it looks like there's at least fewer that will affect us than last year. But this year's market is going to be rough, so our lows may be lower. And don't forget that way the macroeconomic situation impacts long-term holders, creating a stronger flow of sold shares, which would, you know, increase liquidity. Was Halloween this year equivalent to Jan 6 last year? Yeah, there's several other dates that are equivalent to Jan 6th. That's the effect of XRT being on threshold, while the rest of the ETF FTDs clear on a separate schedule. But it gives you some insight into how much they abuse XRT. There's also, you know, there was some equivalence to November 3rd as well. March, was it 11th? I believe it was the 11th. and May. So there was May 12th and March. Right here in March, the 7th through 9th. This one may have had some effect as well. Like right here, where you get this big spike of volatility. But May definitely. This big run up in May right here. See the liquidity come back into XRT over this period. And then you can see that again, and well, if we go back to January, you can see it. And then also in October. Well, no, because if you're rolling it up, you're not. Your credit plus new credit. There wouldn't be any losses if you're trying to get assigned at the same price, right? You wouldn't be buying. You'd just be closed. You want me to say close? I mean, you are rolling the position, but sure, you can roll it a positive. It doesn't have to be a negative, especially at a sold put. The knowledge you gain about GME will be amazing in the bull market. I'm excited. Could be a couple of years till we see it though. Would you say this period of NOPEXs, August, September to now, is similar to that period of NOPEXs between November 21st and March 22nd? Yes, that's what we think. We also think it's similar to the series of very reduced OPEXs between Ryan Cohen's buy-in in August of 2020 and the run in January of 2021. There's some indication that ETF liquidity was used to satisfy a significant amount of the bullishness that picked up on GME between August 2020 and December of 2020. AMC GME to $2. Y'all go in deep red. Cool. I mean, I'm not, but it'll be very cheap to buy up all of it at that price. March last year, we ran 150% in total. If this gen really coincides with the theory being a double deferral and Davies tweet, then we might get a run, which kind of like Jan 21, probably not 120, but 75. That's a way overly. I mean, Gamma Max is nowhere near that right now. We'll see what happens with Gamma Max this week, but right now that's ridiculous. But if we're all gonna grow old together, waiting for Jimmy to come back, I don't think so. If your soul put is negative to buy back, but he's talking about the price going up. We're discussing the price going up. He has a soul put at 17. We're discussing if the price moves up to 21 by the end of the week, and you roll up into the in the money strike, you're gonna receive additional credit. Not only are you gonna take profits off the original CSP that's now out of the money, that was sold in the money, right? But you're gonna also roll up into one that's in the money, netting even more credit. Use ES intraday to help determine direction the SPX is going. No, but I use it to help determine the strength of trends in SPX. That's mostly what it's good for. It also can help you dodge stop losses, like stop loss hunting. You know, if like ES is static and SPX has like a big red candle down, you know, that can be a stop loss hunt, and it can help you time bounces and stuff. Are you selling your protective puts once GME turns around? Yeah, that's what I always do. I just close them out. Close them out, take the profits, roll them into calls. Either roll them into calls or CSPs. Depending on how low GME and Upstart can potentially get before this anticipated score. I answered that about 15 minutes ago, but I mean, we could retest the lower boundary of this. You know, liquidity's getting grabbed a little bit every day, right? Especially over the last 2 days on GME. So, you know, they can use that liquidity that they get during this ETF FTD period to bring the price back down, right? They can use it to short. So I doubt we'll go back to 1540, 1545 again, but we could. Like I think the low might be in. We turned around a little too hard on Friday, but we'll see how much liquidity they grab in the pre-market tomorrow. And that'll give us some idea of how much they're going to short it. Can you comment on how RSS's fatwa of thou shalt DRS has affected liquidity? I assume it's decreased it. I'm trying to understand the extent of the decrease. Thanks. So that's a misnomer. DRS doesn't decrease liquidity. It decreases the size of the liquid market. Which is a little more of an advanced concept and more difficult to explain. But essentially you're removing shares from the total available liquidity, which does things like make cost to borrow more sensitive, because obviously there's less shares on loan. It has no effect on ETF liquidity at all. So it's kind of like I've used this in the past. It's kind of like taking a set amount of a gas, and reducing the size of the container, which makes the atoms in that gas react more violently, but it does not reduce the number of atoms, right? But that volatility, or that it requires less capital to move GME's price, right? So the effect of that means that we can move down harder, but we can also move up much harder, depending on the flow of capital into GME. Explain like a pool of water, and you put a piece of that water in a bottle, but that water still exists. Sort of. Yeah. I'm a scientist and I approve of this gas analogy. I mean, it's a good analogy for what we're discussing, I think. Because, you're also. Well, yeah. I think it works. I don't think I need to explain it any more than that. It's like changing the tip of a water hose. Same volume, smaller hole, moves it faster. It moves. Yeah, that's another way of looking at it. Catching up. So ignore if already asked. So Upstart FTDs plus deferment equals habanero Scoville units of spicy. Hopefully, yeah. I mean, if nothing else, we have the ETF FTDs to lean on, and they're very significant. Not only tomorrow, but the next one's really big. The 5.3 million. We already saw the effect of the 1.9, and that was pretty impressive. So I'm looking forward to that. We're describing PV equals NRT now. Yeah, I mean, pressure versus volume. So you're reducing the volume of the container, or in this case, that would be the size of the market. It's like Boyle's law. Boyle. I fucking. It's been forever since I've been in a chemistry class, but it's Boyle, right? Am I wrong? Is it someone else? Newton? No, it's Boyle. It's Boyle's law. Is a bulk ETF FTD available on the Discord somewhere? Should be in the Upstart channel pinned. My 9-year-old daughter was singing I Could Be Green yesterday. Great parent or terrible? Tough. I don't know. How much of a distorted and cynical worldview do you want your child to have? Is tomorrow a good time to sell all of my GME shares? Jesus Christ. I don't, man. I don't. If you want to, if you really want to sell your GME shares at 52-week lows, I can't stop you. I can tell you that seems stupid. Can you explain your bullishness or Jan OPEX? Like I'm a piece of shit buying weeklies. What bullishness? Chemical engineer, you're correct. Awesome. Before the COVID crash, there was a sharp drop in SPY at the end of Jan before a recovery. Did you notice any strong repositioning from participants before the drop? Or was everyone surprised? It was a bit surprising. I almost took profits on my put position on SPY at the time. But I held through it thinking it would continue to drop. Then it fucking bounced. I had to roll it out. I missed out on a lot of potential money there. Always regret not taking profits on that one. But ultimately the market crashed, so I still made money. But had it not, that would have been very bad. We might not be having this conversation now had the market not crashed shortly afterwards. Did you catch any of Carl's stream Friday? Do you think he should have modded JFresh? I mean, JFresh will just ban all his viewers. So yeah, he probably should have. When was the 1.9 FTDs on Upstart that we saw? 1.9 million FTDs on Upstart occurred on the what was that? That was the day we ran super fucking hard. So that was the 4th. We were expecting them on the 3rd, I believe. Yeah. We were expecting them on the 3rd and they were realized on the 4th. And we saw the FTDs realized across the basket on the 4th. We think that was either the November 25th half day because we counted the settlement from that day, but there wasn't any. Or it was just from the New Year's Eve holiday. I'm not really sure which one, but one of them delayed it. They both, I guess there's some argument for both of them. I would lean into this. I kind of actually want to lean into it being January 2nd because that's during the settlement period, as opposed to the Reg T period, which should just count every day because this is calendar days. More deferral future talk. Assuming you're correct with the deferral thesis, is Jan OPEX action likely to be deferred to Feb? No. And then Jan Feb deferred to March? No. Here's why. There is none of the January OPEX. If we look at January OPEX outside the context of deferrals, none of the January OPEX settlement falls in the holiday period for MLK. The MLK holiday period, these are the dates that are being deferred. The 10th, the 11th, the 12th, and the 13th. October OPEX, or January OPEX, sorry, is on the 20th, with the T+2 the following week. So this deferral does not affect this settlement at all. Versus our previous deferrals that do affect the settlement periods we're discussing. The deferral after the January holiday, the deferral that occurs during the ETF rebalance period, and the current deferral from Christmas. The holiday deferrals explain all the delayed OPEXs in the last couple of years, the ones that we can observe. There is a correlation that's quite strong. I went over this in the DFV video. Do you average down your far out of the money SPX positions or focus more on entering higher strikes as SPX moves up? I do both. I generally don't average them down. I close them and reposition them. If the SPX is moving up hard, I'm not just going to hang on to some fucking dead put as it loses value and moves further and further out of the money, right? That's dumb. Unless you have an obscene amount of theta. Like, more than 90 days. But why wouldn't you sell something when it's worth more and then buy it back when it's worth less? You can make money on the other side of trades that way also. You know, if I'm down 20% on an SPX put that's got a cost basis of like 54, right? Or well, yeah, let's say 54.60. And you know, SPX is moving up and that contract is going to go from 54 to $20. Well, when I close it at 54 and reopen it at 20. Because that's, you know, that's $3,000 that you're not just losing, right? If nothing else, you're not losing that money. Do you think they will run up BTC when they capitulate and run the market before the great dump? Bought some Mara leaps on that dip. I don't know. I don't like BTC. I think it's a fucking waste of money. I think it's worthless except for margin, and that's going to get pulled back with all the FTX and Binance bullshit, which is nowhere near done hitting the fan. This is literally the worst time in the last 2 years to sell GME shares. Yeah. All right. Let me see if the quants are available, and if we can talk about some bullish shit. JFresh.
I'm here.
Hello.
Hi.
What's up, Dirk?
How are you?
Hanging in there. Friday was awesome. How are you guys doing?
Dude.
I'm excited.
Just on, dude.
I got too much actual work to do tomorrow, though, so I'm not excited about that.
I see you're posting a lot of fucking charts.
I always do, man.
I
I
know.
think in pictures.
Wonder if I should post some charts. Dude,
Yeah.
yesterday, Friday. So this is where the financial news kind of got its value, is it told me all about where the money was going, right? Friday was a fat pump everywhere, except
Yeah.
for high yield corporate bonds. That was really the only thing that kind of lagged. Everything else just
HYG.
fucking, yeah, everything else just pumped like crazy.
Yeah, people are still
Uh,
wary of the corporate bonds right now.
Yeah, for sure, as they should be. But it was,
Yeah.
but like that was, I mean, you know, usually when the market goes up, like I'm just kind of like, it went up. But when it's a fat, you know, multi-sector, just everything pump like that, that's pretty bullish.
Yep, I agree. I think we're gonna see a continuation of this into next week. I think people are just pumped up on inflation cooling. Frankly.
Oh yeah, it's very myopic, but it's still exciting nonetheless, because it does, you know, signify that we've broken out of this stupid channel we've been in for the last 2 weeks.
Yeah, it's been.
Yeah, I would love to talk about that channel, but yeah, I think from a specific macro perspective, obviously the Fed's just been saying everything's looking good except for wages. People can't stop asking for more money. Demand for workers is strong, and then the wages came in lower than expected, and I think that's what kind of pushed us off the edge. We were on this, we're balancing on the head of a needle, and then that number pushed us one way or the other.
They called it the Goldilocks readout or something like that. Like it was apparently exactly what the Fed would have wanted. So I think everyone just risked on like a bunch of madmen. The bulls were waiting,
Yeah,
and
I
they came
mean,
in.
bullish leverage is cheap, so I don't see I don't see any disadvantage on the bull side, and I see nothing but disadvantages on the short side. At least for getting any kind of meaningful leverage on the indices.
Yeah, I actually think it was a combination of bulls risking on, but also shorts risking off.
Well, yeah, that's always the case.
Yeah, I guess so. That's kind of a
'Cause-
stupid thing to say. But you know, when I'm always looking at, you know, trying to, whenever I look at gauging trends, I think it's really important to try to separate out how much of it is bulls pushing and how much of it is bears giving up, right? If you're moving up, because those have
Yeah.
slightly different connotations. So
They
that's
do.
why I made that seemingly stupid statement.
That was really interesting actually last week when we started to see all those sold puts on SPX. I think that was like our first good sign of a shift in momentum, or at least a shift in leverage to the bull side, right? Because they're picking up all that credit, right? And then that credit's then going to flow in also, and following all those positions. And we discussed that some during the course of the week, I remember.
Yeah, it's just, I mean, especially with this flat market, and volatility sort of cooling, like variance on equities sort of cooling, I should say. I mean, it only incentivizes people who are holding puts to take profits, and then vol shorts as well. I mean, it's getting to the point where they should be incentivized to take profits too now that the equity prices are actually moving.
Yeah,
So it's exciting.
I agree.
Speaking of vol, though, I think so. I've been trying to put together a narrative that I think is consistent with everything that I've seen, and it's a little bit complicated, and it's why I included those charts.
Okay, I've got
But if
the charts pulled up. We can look at them.
yeah, I would like to look at the first chart I had put up there.
Is that
Um,
the normalized trend
y-
adjusted SPX?
yes,
Okay.
yeah. So I was just working on a theory because I had noticed in, just some of the market headlines that people were starting to chatter about some sort of breakdown in the relationship between the SPX and the VIX.
Yes.
And I wanted to explore that more to kind of see if I can quantify it, if I can identify it and then try to quantify it and then try to come up with a mechanistic argument for it.
Uh-huh.
And so, as you can see here in blue, is a normalized value for the SPX. And admittedly, I used some options chain, neutral type data to figure out what the longer term trend was, and then I just basically subtracted that longer term trend. So then all that was left is just the volatility of the SPX around that trend,
Mm-hmm.
and then I plotted that against the inverse of the VIX, right?
Okay.
Because the price of the
Because of the way
VIX,
they
or the
hedge VIX futures.
yeah, so the price of the SPX should in general go the inverse of the VIX. And the reason for that is because typically the VIX, what happens is most people are long in the market, and so they buy insurance by buying a put, and
Yeah.
buying a put increases demand, right? Because the IV is both based on historical volatility, but then also on, basically made up.
Yeah.
That's linked to just aggregate demand in the market for the options. And so, um, as the market starts to go down, people buy more puts, which increases demand, right? Which increases IV, which increases VIX. So when the market goes down, VIX goes up, and vice versa. But we see that playing out over this whole year. You plot
Yeah.
the inverse, so they should match. But then you get right here to like December, and the market goes down, and the VIX just kind of stays flat,
Yep.
right? And this deviation is like two standard deviations over the whole year, and we haven't seen one this big since last January. And you can't even really see it in this graph because the price is moving so dramatically. So this is a really unique situation that hasn't happened before this year. And I think I've tried to piece together what would cause the price of the market to go down, but the VIX to stay the same. And I think what's going on here is that over the course of this year, people who were long were buying puts to hedge the downside. There was also people who were just going short the market, predicting a crash, and nothing's really happened. And so you're left with these expensive puts that just people have just been decaying theta, and it's just not, it hasn't been as wonderful as the bears would have hoped. And so running into more, more risk, less margin as time wears on, I think what they did here is they started flipping to short vol by selling calls, right? So taking their long collateral, margining it to sell volatility to try to recoup some of their losses. And so what happens here is when you sell the calls to the market maker, you're decreasing demand, right? So IV will drop. And so what happens is that as the price of the stock drops, because when you're selling calls, the market maker's selling shares into the market and dropping it, it's also dropping IV because demand for calls is going down. So I think what the story is, all of that to say, I have another chart we don't have to look at, but it's basically showing that
This
liquidity in the market. No, it's another one, but you don't have to pull it up because all it basically says is liquidity is still dry in the market. Everybody who, after the last crash, I mean, everybody's just been holding on. So everyone's still got their long positions. Their short positions kind of were lackluster, so they all sold calls to try to short vol and get some of that back. And all the while, just all of the short interest is just kind of come to a head. And so I think right now what we're going to see is people buying back calls to close, people closing long puts, and price to continue to go up, at least until this variation of VIX resolves. So I would not be surprised if we easily hit 40, 50 or so, somewhere around 4,000 before it starts to resolve. We'll have to see.
Yeah, I can see us peaking back above the trend on this momentum. And I also, and something me and Dork were looking at a little separately, the returns on short positions on SPX are, they've already peaked. Like the rate of return on short positions on SPX peaked. Fuck, how long ago was it? It was back in October, really. But even that was less substantial rate of return than back here in June. So shorts aren't making money right now, and everything you're pointing out in the options chain is also indicative of that. And how long can they stay solvent against a market that's not agreeing with them, right? Eventually they have to reposition, and what better time than the beginning of the new year, after losses have been realized for the tax year. It's time to take out some new position. I really don't think we're going to see any significant short leverage until we get some serious cooling in the VIX. And we saw a little bit Friday, but not nearly enough. I think we need to see the VIX sustain below 20, ideally 18, for us to see some actual buildup of any short positions that would target, quarter 4, quarter 1 earnings. So basically, I think in order for it to ever dump this year, if it's going to, we need a run. Otherwise, none of that positioning is going to be possible.
Yeah, and I think we're in this really weird situation where it is true that this correlation between the VIX and the SPX is kind of starting to break down, and I think it's because of that covered call strategy that's being deployed in the last month or two. But it'll be interesting to see. So we might actually be in a situation where over the next month, if they do start closing these covered calls en masse, we might actually see the price of the market rise and the VIX rise. but that kind of depends on how many puts, what's happening on the put side as well to get the aggregate demand on the IP.
Generally at the peak of runs, you begin to see an increase in VIX, or at least this year we have, and that was indicative of, interest flowing into the put side, right? Like I know here it wasn't so much here in August, but we saw a little bit of it here in August. But then more and a lot more here when we approached like September. Like September 9th, that last rally before the big downside came in. That's really where we started to see the market and VIX move up simultaneously. Because no one really wanted to buy calls on this. They just wanted to get as many puts as feasibly possible, right?
Yeah, I think another thing that's interesting is the VIVIX. Someone mentioned that earlier, I think, in your stream. I think it hasn't been this low since I think 2014. I definitely think that's going to spike. So what I think is going to happen is the market's going to continue to move up. The VIX is actually going to move up a little bit or continue to stay flat.
Yeah.
And then VIVIX is going to spike.
So I agree that the market's going to move up, and I think VIX will stay flat or continue up slightly. But I think eventually, I could see VIX just moving up a lot with the turnaround in VVIX. Me and Dork, actually Dork, if you want to go over that, me and you discussed this quite a lot earlier this week.
Yeah. I remember we were having the discussion about it. So the relationship between VIX and VVIX and SPX can sort of give you insight into the momentum of SPX, sort of like a leading indicator thing. VVIX is the volatility of the VIX, and VIX is the volatility of SPX. So when you see VVIX go down, that means that the volatility of the VIX is going down, which could mean one of two things, but it generally means that volatility shorting on the VIX, it could mean volatility shorting on the VIX, or that VIX options are just kind of closing out, right? So when you see a drop in VVIX, eventually you will see a sort of a drop in VIX, I think is kind of the conclusion we came to. And we were quantifying this by examining the price uncertainty of VVIX and VIX and SPX, and seeing how they sort of evolved with each other. And the pricing uncertainty of VVIX going down definitely does sort of indicate that
in the future volatility will drop also, right? Well, yeah, I mean you lose volatility on the VIX, and then that's going to translate to a loss of volatility in the market, or a decline in volatility in the market.
Exactly, yeah. So you could sort of, and the inverse is also true. When VVIX starts sort of picking up an uncertainty, that there is probably going to be a spike in VIX. So yeah, that was definitely an interesting discussion. I mean, we were, I don't know if we necessarily rounded it all out ultimately, but it was certainly interesting to see those sorts of correlations. It would be from several days to a day before any sort of spike in VIX. You would see VVIX sort of behavior getting more erratic.
Yeah,
it was very cool.
It is kind of cool.
But I posted a couple charts just a second ago.
Okay.
They're just those returns we were talking about. So these are kind of like an incentivized return chart, and they sort of mush together volatility and returns on a 60-day rolling position. And kind of as you can see from, I think the second chart shows it pretty well. That one has the average returns of VIX, VVIX, and SPX as the blue line, and then SPX is the green line. it kind of shows what Jay Fresh was sort of mentioning, and you as well, that VIX will probably stay flat as the market continues to go up.
Yeah.
But the the 60-day rolling position right now favors the longs, which means that anybody who went long over the last 3 months right now has increased leverage in their position.
Yeah.
So this is, I mean, and it also, you're saying, shorts haven't been making money since October. Yeah, October, November. I think you're absolutely correct. And ever since then, they've been losing leverage. So the incentive to close is a lot higher than it was back in October, November, where they were just holding on.
That's really getting bad over the last couple days. Now they're
Oh
starting
yeah,
to not
yeah.
only just be flat on their positions, but they're experiencing losses.
Exactly, because the sharp increase implies that the variance in the position, is sort of starting to die down, which means that they're, losing leverage in a compounding fashion, not just from delta, but also from a reduction in volatility as well.
I agree. Jay Fresh,
So it,
any thoughts on that? Or at
I
least
guess
how
to get his
that
peg over.
analysis corresponds to the options data that you just presented.
I think his kid wants a Go-Gurt.
Oh, fuck. All right. Well, he's down for
Oh
the
shoot,
count.
sorry, I was muted. No. My kid. I'm actually, ironically, the only person in my family not in a hot tub right now, and I can't tell you
Stop having children.
how sad that makes me feel. Well, no, because I'm in here talking to you. But my youngest son came in here to tell me that he was wearing a poop towel. I don't know what that means. There was no poop. That he's wearing a poop towel.
Is it
Anyway,
just
so
brown? Is it just a brown towel?
no, it was a Little Mermaid towel.
Maybe
Anyway,
maybe in the
so
past he'd used it for poop.
I don't know. He's already pooped like 3 times a day. He's pretty obsessed. But yeah, so I mean, I think this data correlates pretty well to everything that we're seeing in the options chain. And what another piece of data that is also really interesting to me is the fact that, and I just looked this up about an hour ago, and so if it changes, I'll let people know on the Discord. But I was just looking at the change in rates over time, the Fed rate. It's been going up all year,
Yeah.
and if you look at what the options market is pricing in the risk-free rate to be over the course from I think September till now, the federal risk-free rate has gone up about 1.5 percentage points, and the risk-free rate on option exchange has stayed completely flat, which means that
Yeah, I
puts
noticed that too.
puts remain overpriced. So nobody's selling their puts yet.
Well, people
Well,
are
not
selling puts at a premium, right? But no one's buying more.
yeah, but
Outside of the
yeah.
market
So
makers, right? But the market makers want to buy the puts at a premium. It seems like the
yeah,
market maker's
yeah.
willing to take on that additional cost to buy the puts in order to leverage themselves that long.
Yeah,
A
but there's
delta.
I mean, there's really, I'm trying to find a bearish way to look at it, but there really isn't, because it's just showing that, there's a persistent downside bet or pressure on the market that the market maker wants to capitalize on, that people haven't fully let go of. So there's still a lot of room for them to let go.
Yeah.
And yeah, I mean, the market, calls are cheap. I mean, the market will eventually restore itself, right? I mean, there's just too much arbitrage between the rates and the options chain right now to the bull side, that eventually it's got to come to a head. I'm excited to see some shorts get screwed.
We've been waiting years.
Waiting a long time.
Yeah, it's
Um,
been a very long wait. Don't forget that, as we get all bullish like this, there are things that can still break due to a climbing market. It doesn't, not everything's fixed. There's still issues with treasuries, foreign held treasuries. There's issues with the dollar value increasing. So I think it'd be remiss of us to ignore that.
Oh yeah, I don't
there's
think it's going
still
to go up
there's still
forever.
many persistent conditions which can lead to a lot of downside very, very quickly. But right now it does look very good in the short term.
Yeah, that's an interesting thing because like this next bounce, I mean, we see a lot of risk on behavior, but you have to wonder, I mean, is that risk on behavior just reflective of of the repositioning of the short side, right? If they are starting to reposition, it would look super bullish and super risk on. But within 5-10 days, it can become super bearish, right? As
Very
they
quick, yeah. If VIX,
Oh
I
yeah,
mean VIX below 20 it's put season, right? And the lower VIX gets, if we do see a cooling in the VIX on the market move up like we saw Friday and that continues, oh yeah, people are going to be buying a lot of puts.
yeah. I mean, I think right now we're seeing shorts reposition. I mean, longs simply haven't sold. So
Yeah, well, I've been over this with a lot of the bears in the Discord. There's nothing, if you bought in the COVID crash and you're holding a core position in an institution, there's fucking zero reason to sell that position right now. Even
yeah,
a
just
slight contraction in margins, you may hold. Now, a big contraction in margins, that's going to affect your forward potential on that core position, right? You need to rebalance your core position and shift your ownership into value. That can create large equity sell-offs, right? But
we're a
right
long
now,
way from there
everyone's still fucking
though.
up. I mean, everyone. Here's the problem: is everyone in the Discord started participating in the market
At the top.
beginning to mid bull run in 2021, right? But a lot of them missed 2022. I have shit I bought in 2020 that I'm never gonna sell. It's just up. It's gonna stay up. It's marginable. I have no reason to get rid of it, right? And it's just like, unless there's a significant turnaround in these companies' forward statements, why sell? If they're going to continue to make money and continue to make profits, and you're in at a 10-year low, well, fuck it, you're not going to sell that position. And without large equity sell-offs, you don't get a crash. You need fear, and you need the bulls to have fear, and that's hard. Bulls aren't very scared of shit. If you've ever met one.
Oh yeah, I mean,
I
well,
think I'm a bull. I know I went really bearish
I would
in
say your
summer.
risk management is in line with a bull. I've heard about your daily deployment of your children's college fund into GME.
I'm just yeah. No, I'm bullish.
I know
I
you
know a
are.
lot of people are in deep despair on GME, and yeah, it's uncharted territory, and it feels like it's going to go down forever. But
It always
I
feels
don't
that
feel
way.
I don't feel that way. I
I'm not.
see. Well, I mean, so what we're seeing on the market is kind of what I've been expecting and waiting to see on GME, because I see a lot of the same things. They changed their strategy after the split from buying a ton of in the money puts, which they have still done.
Actually, I don't know if you were around for that conversation or that part of the conversation that we had with Turd, but it was really interesting to look at the correlation between GME and XRT from May to August, and just like another data point that kind of reveals that they just walked away from the short vol positions, which would still mean that our overall or overarching thesis of all of GME's price actions simply being driven by these synthetic short positions is still accurate. And the
Yeah,
only
but but
only
I
data supported theory that I've heard on GME so far.
but the thing that that's been occurring recently, like in the last quarter, is just this endless barrage of sold calls, right? I mean, usually we look at sold calls and we think, bullish momentum is killed. People bought calls and now they're giving up before we saw anything. But it got to a point where I was like, okay, there's more calls being sold than I think were ever bought.
Yeah,
And so I think that's what's happening right now is, short vol by selling calls, which is happening all over the market. You get the benefit of theta working for you instead of against you. And so when those close, things start to get exciting. So you have shorts who are buying in the money puts to keep the price down to protect their short. There's their real shorts with
Yeah.
synthetics, and then you have the vols who are keeping the price down by selling calls.
What's really interesting about that, and here's where this gets exciting, I think, and I don't want to interrupt your train of thought, but I want to point this out to people. Is that given the nature of these positions and the synthetic liquidity used, there's kind of a interesting caveat with those sold calls, is that not they're not collateralized, they're naked sold calls, right?
Oh yeah,
And what's really interesting there is that the ETFs do not have the liquidity to sustain the OCC margin requirements for those calls moving into the money, right? Because those shares don't exist. They cannot be collateralized with the OCC. And when you have a call that moves in the money, it very much acts the way DRS would. The OCC demands collateral proof from the broker dealer. I actually think the requirements are a bit more stringent than a locate, because those shares become then deliverable to the counterparty, right? And this is something we noticed with the effect of retail selling large amounts of covered calls in the past, is that as the price moved up, the capitulation of those covered calls, the pullback started to affect the borrow rate, like we saw in May. May saw this massive increase in borrow rate in a very short period of time, because all of a sudden there were all these collateralized calls going in the money, and the OCC was pulling back all those shares, and then that leaves the only pool of available liquidity, the borrow pool, right? And so it gets kind of interesting that they have these naked calls that are out of the money, but they can't let them go in the money. So if they're at risk at maybe that gamma flip point, which they're mostly sold above, but if they're at risk, they have to pull them back immediately, and that is a huge catalyst for price action from the market maker side.
yeah. Well, that's why I was so excited on Friday when, at the end of the day, when we saw that huge movement up. That was all closed puts for Jan 20 and Feb 7. And it's something on the order of like $10 million worth of them were all closed within the last like 30 minutes. And that's huge because that's likely shorts helping push their position with more synthetic shorts. And if they start closing and put pressure on the sold calls, then it could all come unwound very quickly. And so I think what's going on right now is the shorts on the equity, right? People who are short the stock and then long on puts, they're probably going to crowd out the vols, and then they're both just gonna squeeze each other.
Yeah, well, that's something I think that's so important about that deferral correlation that we found, and even looking at stocks like Upstart and Fubo as well, and Fubo less so because it's so liquid, but
Yeah,
you have to remember that everyone is really still stuck in that super strong frame of mind that all of the institutions are working together, they're all evil, and they all have the same anti-retail goal, right? And there is a cabal of them working very, very closely with one another to ensure the downfall of retail investors. And that's not really true. And I think looking at this situation like that is a big mistake, because these short vol positions are not aligned with the long shorts, and the
yeah,
long shorts are not aligned with the longs, and the short vol positions and long vol positions are kind of in the middle, and their alliances shift as initially, when after a run, short vol is very much aligned with long short,
yeah,
but over time they become more aligned with long vol, and thus long positions, right? And it's the movement of this position from highly liquid to low liquidity environments that changes almost, you know, how, like, I guess we could say how bullish they are, right? And you know, they move from extremely bearish to very, very bullish, and it cycles back and forth. And you know, if people are buying the downside, then they're creating counter pressure to the long short positions, which eventually, you know, would force long short positions to capitulate to the volatility created by short volatility players.
Yeah. And I think, I had some, I don't remember who it was in Discord, but they were pushing back. I was obviously, I get overly bullish very easily. But I was super excited about these deep in the money puts being closed. And I made bullish statements like the shorts are getting spooked, and people push back on that and says, like, the shorts are still very profitable. Nobody's getting spooked. They're just
Well, no,
positioning. And
they're not, right? I mean, I think me and Dork can pretty much attest to
I talk
that.
about GME in specific.
Yeah, I think on GME specifically, the shorts have run out of room for profitability. They did a little while ago. Our last big drop here on it was like leading into December 28th. After that, there's almost no profitability in the short position anymore. Everything after like that point, and really like the 20th, there's a little increase in profitability here through like 27th, 28th, but not a lot. And most of this downside barely profitable. Believe it or not, because it requires so much money to drop the price more because of,
Yeah.
you know, how illiquid the secondary markets have gotten, that there's no longer a big arbitrage benefit to this. And that's something that Turns data highlighted also, is there's just there's no money being made between GME and XRT right now. Actually between XRT and any of its underlying stocks. And that's not a position the ETF wants to be in for very long, right? Because that'll cause everyone to leave it, which could cause the fund to collapse. And it's definitely not a position that APs want to be in for very long. And you know, if the short vol positions are tied to the APs, which they could be, or are APs, which some of them are, then you know, this is not ideal for them. This delay in covering of liquidity is not beneficial to their positions. They've already positioned long vol once in December. They've now rolled those positions to Feb, right? So they've lost money on this cycle, which is not ideal for them, by not timing the ETF recovery of these shares. It's really interesting once you get down into the really granular data of how these positions are moved around.
Yeah, and I think, back to this very specific point that I was trying to make about why I was so bullish about these particular in the money puts being sold off is, yeah, I mean, nobody's collapsing, with this sell off, and the selling of those puts was probably quite profitable for whoever opened them. At least that portion of their entire position, that trade was a profitable trade.
Yeah.
However, however, it's what it signifies, right? It signifies that somebody who's so deep in the money that the only value remaining is just the delta between the strike and the spot.
Yeah,
There's
there's
no
no extrinsic
reason
value on those contracts.
there's no reason to close it early unless you think the bottom's in,
Yep.
or heaven forbid the price might go back up. And so it's a very bullish sign when over the last month we've seen nothing but just bear option trades slamming the hell out of this out of the stock. We're seeing some capitulation of that, and they were sort of up at like $25, right? So quite exciting, I
I
think.
closed my protective puts on Friday too.
Oh, maybe that was you.
I didn't have that many of them. Not that deep in the
You didn't
money.
have $10 million worth of
No,
25
I
puts
wish.
on. Yeah.
I'm just not that rich. But DFE maybe. I mean, if you bought protective puts in the August run, I'm serious. Right?
Yeah.
If you bought
So
protective leaps at that point, they're or anybody long the stock, BlackRock, Vanguard, right? They're
yeah.
gonna
So
use
so I'll
protective puts as
I'll
part
give
of their
this over to
strategy.
Dork because I think he has something he wants to say, and he just popped up another chart, I think. But I will say, yes, all of these shorts right now look great on the books. Number one, I'll say I think Icahn is full of shit, and his cost basis on his short is not $400 or $100 or whatever. Maybe part of it is, but no way. No, nobody's got that much meat on the bone on their short position. They're just hanging out right now, holding it. So all these shorts right now, their position looks positive, but there's no liquidity, right? And they know that once anybody starts to cover, that positive position just starts to evaporate, right? And so there's there's just so much potential momentum built into the stock that I don't know. I'm excited. I think the bottom's just about in. So everybody, you all can make fun of me tomorrow when we drop below $15. I'll just
I
buy
think
more.
there's still potential for us to move down in the coming days. I don't think we're necessarily going to rip tomorrow. Remember, the market makers got T plus 2 and then maybe plus 2 before they have to do anything with those shed puts. But and if there's not a lot of volume, they don't need to act on the loss in their hedge, right? But before Dork hops on, I do want to point out a question from the chat. Can one of you guys give a devil's advocate if deferred Jan OPEX is not realized? Yeah, I think I can. But it's not very bearish. If we're wrong about the timing of this, then we just go back and we look at possible different timing structures for these deferrals. I don't think we're wrong about the idea of the deferrals, but obviously, yes, they're very hard to track. The one I came up with seems to have the highest correlation, but there are others that we could look at, and there's ones that are a little less correlated but can still fit. What I will say though is that this reversion of liquidity is not an option. So if you don't play the long side and you don't try to chase the price action, you can take these positions with far less risk. You can just simply target profiting once it's already run, the same way that Citadel and Susquehanna do every time. You do not have to be on the long side of the trade. You can wait for the run to occur at whatever point it occurs without attempting to time it, and then you can reap your profits on the upside instead of attempting to time the bottom and make money both ways. So there's even if we're wrong on the time and the date, and obviously this theory is fresh and there could be a lot wrong with it, and a lot more to learn about it. You don't have to be on both sides of the trade to make money on this, and I think it's really
I'll chime in a
important
little
to
bit too, just because I've always been the one that's been the least forgiving on the theories of the ETF, simply because we just don't have the kind of juicy data that we need to really just nail down these
so much of it's
correlations.
just never disclosed anywhere.
Right. There's just not enough data to say for sure. I will say I'm definitely still quite compelled by the ETF theory, because we do seem to have positive price action on days that seem to have no correlation to anything else except for Girk counting, right? He's really good at counting shit up to around 35 or so. Um,
I'll
so, I
never
mean,
forget the
obviously,
ETFs that ruined your day. The ETF FTDs that ruined your day in August.
uh, anyway,
Sorry about your puts.
yeah, that was rough. That was a rough summer learning to be a bear, and then to not be a bear all the time. Anyway, learned a lot. Still standing. But yeah, so if nothing happens and we don't see a pop, it could just be that these ETF obligations weren't as large as we thought. It could also be that somebody's just failing a position and it's going to take a couple months for it to wind down. I don't think we're really going to know for another couple months after Jan if Jan doesn't run. It'll take us a while to try to piece together what's going on.
Yeah, that's the worst thing about these is, you know, we can put everything together, we can correlate everything, but ultimately we have to wait and see if we're right. And then if we're not, then we have to go back and we have to figure out where we went wrong, what was wrong, because it's not something we can test every day. You know, it's something we have to test like once a quarter if we're lucky, and sometimes a little longer than that. That means that, you know, we can't refine the theory for several months at a time. I do think it gets more and more accurate, and I think we learn a lot more every time it doesn't go the way we want. Probably more than we learn when it does. I think when it all works out, then we just, you know, fill ourselves with false confidence, and that's a dangerous thing too. But hopefully the analysis leading into it keeps us from that, and we can you know, remain level headed on our predictions and this data analysis we're doing. That is not. I might also add that none of the stuff we're doing is really academic or used by funds. We're kind of approaching this from a whole new analysis perspective, and so yeah, it's got there's some issues, you know, that need ironed out.
Yeah, I'll just say that, yeah, I can be both really bullish based on all of the data and the mechanics that we understand, and also not be confident, right? So I'm just because we're all excited, we're partially, I think a lot of that excitement that people don't wrap their heads around is that we're just excited about testing our theories.
Yeah.
And so we can be excited even if we're not confident in being able to make a ton of money necessarily, because we have that intrinsic puzzle, you know, that we're putting together a puzzle, so we're excited about that, right? But everybody else
I'm
seems
not
to
gonna
get
lie, I
excited.
think most of the people that are still in this at this point are also probably more
Well, I
excited
hope
about the
so.
puzzle. But there's
I
people
hope
that
so.
aren't, you know.
As you know, I like to mingle with the poors. I find them
I know you do.
fascinating, and their devilishness and deviance is exciting to me. So I hang out with them often. Yeah, I feel like they still get mad when things don't go like, oh, you made it sound like it was a sure thing. It's like, no, we're excited because.
But do you ever look at like Dillionaire's chat during that period? It's funny, and I don't understand why. But like Dillionaire's chat, I mean, almost nobody's playing GME. Everybody's just like on other stocks. Like no one's really like OPEX won't happen, and people will be like, ah, fuck, you know, maybe I bought too many calls this time. But like, I've never understood that contrast for $25 a month between the two. Like you'd figure almost everybody would be on the same page, but they're not. I guess they've explored more opportunities in the market outside of GME, and that lessens how bullish they get on GME. Versus, you know, the poor chat where almost everybody is balls deep in GME far more than they can afford to be. And downturns in the price are
Except for
extremely damaging.
Ricky Ticky Thummy, who's got 4 shares DRS.
Man, he's ready for the infinity pool. I'll give him that much. If his forklift certification ever falls through, he's set for life.
All right, let's put Dork out of his misery and let him speak.
Yeah, I know. He's very excited.
I'm enjoying this. You guys always say fun shit. But I mean, all I really wanted to go over was kind of, I think what we're seeing on GME is reflective of something happening in the broader market. So I put up a bunch of charts, and we don't need to show them all. The first one is just GME compared to SPX and VIX,
Okay,
and
yeah.
it's a profile we see across the market in a lot of like even like mega cap stocks. Where you have this big divergence from the underlying returns and the index, but the average follows almost exactly in line with VIX, right?
Yeah.
So,
Well,
you know,
recently.
Yeah, so and this sort of lends credence to my personal very tinfoily spin on what's happening on GME, and that it's just an artifact of a much broader market sort of thing where we have long vol in the market against short vol in the market against longs against so there's a lot of interplay happening between all of these derivatives and underlying positions.
I couldn't agree
And
more, by the way.
Yeah,
yeah,
that's completely in line with yeah.
so, and yeah, that's kind of the basis of an operating under that. You see this on very liquid stocks as well. It's just much more subtle and hard to suss out because there's just a lot of people doing other random stuff on it. But overall, you see a massive divergence in the returns of the index and the underlyings. And what that tells you is that there is a ton of pressure on the shorts on the underlying to sort of take profits before uh, overall sentiment improves and their position gets blown up.
I agree. Yeah.
So,
Yeah, eventually the weight of, I mean, don't forget about that active fund trading. Eventually the weight of that active fund trading can imbalance their position, and we already know there's so much risk to the upside for them that, that point of capitulation is obviously very intriguing.
yeah, well, the outperformance of the index, and plus the average and the VIX returns, sort of being equal to each other, sort of tells you that that positions are fully hedged, right? Everyone's got their hedges and stuff, and now it comes down to picking a direction, and without any bad data to sort of continue to support the bears, sentiment in the market will slowly improve. People
Yeah.
who are managing funds are going to be looking at that data and saying, "Oh, this is pretty good. I
They're
think
going
this
to
is what
turn
the
the
Fed's going
dial
to do."
up on the 401ks to 11.
Yeah, exactly. Yeah, exactly. And also people who do actively manage their 401ks to some degree, their contributions, they might start picking them up now. It's if overall sentiment shifts and the big indication of risk on Friday, all that sort of tells you that sentiment really did shift in a very measurable way. And this big divergence, it should sort of come back into line with each other. Whether or not it's positive or negative, I think we've sort of picked the positive side. And you could sort of see that on the Apple frags. You can sort of see that there was a big shift in sentiment and that returns on a short position are starting to go down.
Yeah.
Um, but yeah, it's all just very exciting, I think that this is just sort of the first signs of also not only that, but obligations that need to be resolved that are going to be either rolled or closed are going to all sort of come to a head. But that decision was made a while ago, and then was deferred throughout the market, and possibly to obfuscate who did what. Um, but what happened on Friday too, that being roughly 5 days from the start of the deferral window,
Hmm.
is very, very exciting. That was sort of what I was expecting was some sort of big shift somewhere, a lot of volume
Yep.
sort of thing.
We talked about January 7th in our last like big, well, I guess it was the last one. It was the last, uh, you know, number stream.
Yeah,
We
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 did. We
discussed
were
we discussed that T+5 period as being possibly important in while and while this may not lead to necessarily a lot of price improvement, it can really lead to a lot of us beginning to see a reversion in like a reversion to mean liquidity in the secondary markets surrounding GME, which will then propagate a primary market liquidity event.
Yeah, absolutely. Yeah, well, it's technically, I guess, T-5, right?
Yeah,
Uh, because
'cause it's a countdown.
to kind of dig deeper into why T-5, every creation redemption has a 5-day settlement period. So,
That's tricky.
yeah, right. It is,
Don't
but
that so that statement's. I'll go into it after you're done, but that statement's not entirely true.
right.
But from a balance perspective, presuming no uh no allowances are taken, then yes.
Right. Yeah. So I'm just it's a base case that you can kind of work with.
Yeah.
But it sort of tells you that a lot of, and plus the even performance of all the ETFs, they are all the returns of all the ETFs are following a very tight channel. And it sort of tells you that somebody or some, just a lot of people are trying to create a situation where whether it's redeeming or creating or what have you in the process, it tells you that they want that process to be resolved within 5 days.
Well, we've discussed something else, and I want to kind of touch on this while we're on the topic of these ETFs. Um, you know, it's really important to understand how this trickles down through the market. And maybe it's like a market structure thing that a lot of people don't get, right? But you have these positions on the indices and in futures, and they're capitulating and repositioning, right? And people go, how does that, if the index is just a reflection of the underlying shares, then why does the capitulation on the index matter, right? And that's because of the way that those index positions and then the ownership of those underlying shares are hedged, right? And then that leads into what Jay Fresh was talking about earlier, and how they're shifting their hedge on the VIX, right? And then you know that causes them to then you then have ETFs that are tracking these indices, right? And that the hedge on those is going to change, right? And and then since those ETFs are then used to facilitate liquidity for the underlying stocks and also to hedge positions in the underlying stocks, then that then affects equities at the base level, right? And so and because of the synthetic liquidity transition there, leverage actually increases as that moves further and further down the chain, and what you end up with in these capitulation situations and large repositionings is you actually end up with equities outperforming the index that's tracking them. And I think we've seen it enough times now that we can say this pretty confidently. Because the ETFs act as a compounding mechanism for positioning, and increased leverage on the underlying equities. We saw all the shorts move into ETFs, and that caused crowding in the ETFs. It made liquidity harder to get in them, right? And now if we see shorts move out of those ETFs, that becomes very explosive very, very quickly. In the same way that we saw rapid downside, we can see that rapid upside as that transition is made between these various instruments.
Yeah, and it's also important to consider that a lot of positioning that's happening on the underlying equities and their options markets is partially to sort of negate that behavior from the ETFs, right? So if you're expecting a positional change on an ETF to increase volatility across the basket, you'll just short the volatility on the basket while it happens.
Yeah.
So the whole short vol thing and going long vol, it shows, especially with GME, but a lot of other places too. It shows that there is some entity out there that is expecting volatility on a lot of stuff, and it's a little biased to the upside too, but the rolling of it too kind of, that was interesting because it tells us that they may have messed up their deferral window too, or it may have been an issue with the ETFs themselves.
They did spike volatility on GME a little bit during that period right before they rolled. So they shorted real hard to get their volatility so they could move their position, which is, and obviously you can get volatility, you can get more volatility to the downside than you can to the upside actually. Usually, generally speaking, outside of very specific scenarios, volatility on the downside is like a compounding thing as fear increases, volume increases, and Generally, short side volatility spikes faster than long side. But yeah, I agree.
So, I mean, I think that like all of this stuff is lining up really nicely. But because of that, once again, I always have to sort of bring forth the voice of reason that says things could be looking really good because they're looking really good, or things could be looking really good because everything that we're not looking at is absolute shit.
Well, you have Tootsie Rolls, so you're safe, right?
Oh, dude, yeah, my
Yeah,
my,
so
my dividends, what's it at, 0.7% or something, dude?
you've already made like 45 cents this year.
I have, yeah, it's right. In 20 years, I'll get another Tootsie Roll, Sheriff, if it hasn't gone up too much.
Fuck. Your grandchildren are gonna be just so lucky when
Oh
your
yeah,
will
once
gets
they're
out of
like on their
probate.
deathbed, they'll be like, "Hey, look, I have 3 shares of Tootsie Roll, and it's worth $100 a share.
Yep.
70 years and about 100% up."
uh, so just to answer something, Christopher Morganson, being happy not making money, I need to head out. Shocking statement. See you tomorrow. It's not that we're happy to not make money. I mean, most of the time, I would say that all of us are invested in our thesis. I think it's pretty rare that none of us, and before you guys ever even heard any of these theses, when they were still very much in their infancy, we were heavily investing in them.
Oh man, August through Fred's Day was
Yeah,
amazing.
yeah, we blew a lot of money on things like golden biscuits and
But August was so good.
fucking future rolls. Remember the future? Fuck, goddamn. But that brought us to, and ironically, back then we didn't really need to be that smart with the thesis because everything just ran on time. And so there was still money to be made. We might not have made a lot, but there was money to be made. And then this year obviously presented new complications with the split, and
Bear
the
market.
deeper our understanding got, the more the timing got fucked up. And so many deferrals, so many OPEXs landed in holiday periods. We had the risk off with Bobby that fucks up everything, and and we don't know those things can happen until they do. And so, no, we're not happy to lose money on any of these. We're extremely happy if we're both right and make money. But if we're
Yeah, that's the
wrong,
goal.
if we're wrong, we're not defeated. We continue to pursue it.
Yeah,
And
make no mistake,
maybe
we've all lost
maybe after
money.
being wrong with even more alacrity than right before we're wrong, right? Because now we have all this incentive from being wrong that pushes us even harder. And I think finding you guys was huge in that. All of you guys on the quant team, because I found people that are like me in that way, where being wrong just means you try harder. And I think we've come really far because of that.
Yeah, I tell people all the time the fastest way to be right is to be wrong.
Yep, I agree.
Yeah, make no mistake. The quants lose money when these guys lose money. I don't know necessarily, like, I mean, like, it's not that we're just saying this stuff and then not positioning. We're not full porting because we're not stupid, but we're all positioned for these things. And what's, I think, the silver lining from this bear market and all the timing getting just thrown off and everything like that is it's actually exposed sort of the more intricate things that can happen, right? In 2021 there was enough liquidity to just do whatever the fuck you wanted. In 2022 people have had to really kind of batten down the hatches on how their money flows, and because of that we've seen not necessarily tricks be employed, but how liquidity and where and what direction the liquidity is in affects, things like OPEX, how deferrals are leaned on, and things like that. So I think that there's a silver lining in all that. And yeah, we've lost money, but we're still, I think, pretty stoked that we've just, every step of the way we've learned something new, which is to me the most exciting thing you can do in life.
Yeah.
And somewhere buried in all of this chaos there are companies that are using the markets to raise capital. Maybe.
Yeah.
Citadel.
Well, here's the thing about this. If we ever do figure out every aspect of it and every nuance, and we get them all laid out, and solved, the value that presents is
that's
it
the
can't
day.
be quantified. That's the day
That's
I
the
shut
day
down
when
the stream.
Citadel. Well, that's the day when
Yes,
Citadel
I'll
and Virtu just push forward some new DTCC rules.
Probably, yeah.
Yeah.
But once we're caught up, though, I mean, we're caught up. It's a much less of a chase when you're already, pretty close. But compared to where we were in 2021, I mean, we're leaps and bounds closer to, I think.
I mean, if this
Getting that.
deferral shit had happened in 2021, we would have been lost for months. We would have not
Oh, yeah.
known what was going on. But
Yeah.
because we can go back to our data and look, and our data has become so much more accurate and so much more complete over the last year and a half, when something happens, when a little thing is off, we can go back and identify it quickly, and every stage of that we get a little faster, and then hopefully there will come a stage where we're ahead of that, and that's exciting.
Yeah, I mean, I'm just reflecting on what we've been doing for the last 2 years, and we're literally trying to do something that is insane, right? We're trying to nail down enough of the mechanics of the market that we can. It's almost it's. I kind of think of like the Matrix and seeing the green letters and stuff scrolling on the screen, and you can actually just see what's going on. Everybody says the market is just completely chaotic. There's too many inputs, but we're basically saying, yeah, maybe, but we're going to try, right? And it turns out, I think because wealth is becoming so highly densified up, with just a few players, it's actually not as difficult as you think once you realize that most of the money being thrown around is being thrown around by like a couple hundred entities.
Yeah,
And
that's
maybe markets
feel
are
like,
far more predictable than people assume.
Yeah. I mean,
But
I've always
we'll leave
believed that.
at that, right? We don't need to.
Yeah.
We don't want to
Yeah.
overshare during show and tell.
We
when
don't
I
want to
say
get
damn it,
we don't want
Jamie
to
Dimon, I
get
mean,
disappeared.
I'm only half joking.
I really want to punch him in the taint.
Jamie Dimon's just short. We know he's short the market, and he just says a bunch of bear stuff, and who cares?
Oh yeah, I mean, that's why I blame him whenever the market takes a shit.
I mean,
It
it's a lot of
probably
the
is.
times it's his fault, right? I mean, it's
Fucking dick. Yeah.
but
It is. It's cool because I mean,
so next guest, Jamie Dimon.
Let's do it.
let's do it. I'm down.
He can't
Either
be
him
that
or-
hard to
either
get.
him or
Like, no
Ken
one really
Griffin.
wants to talk to him, right?
Yeah, it'd be irritating. You'd start talking about jobs and then we get annoyed.
You know what I find really interesting? I wish there were a lot more professionals or ex-professionals from the mechanic side of the market that talked about it. It just seems so crazy to me. There must be.
I've reached out to a few. I've reached out to some of the guys who did all that research on operational shorting and ETFs. Nothing. I reached out to guys who work. I reached out to a couple guys that were ex-employees and now professors from various clearing houses, and nothing. I reached out to a couple of people that were former employers of the DTCC. Nothing. I reached out
Have
to
you considered?
ex-ETF managers. Nothing. Right? They don't want to. It's you
Have
have to
you
understand the industry to
considered that it
understand
could
that.
be that you're a YouTuber on a pickle themed channel that might be turning them off?
No, because that wasn't actually brought up in conversation.
Yeah.
Like I never got far enough to tell them that we may have to talk about bidets for 20 minutes, right? Like or my audience thinks I'm a centaur. But the real issue there is that this is an industry shrouded in secrecy,
Yeah, it just
Right.
seems insane to me. Like we
Well, like,
literally,
And
there's thousands of people that
there's
have built this thing over decades, and the only person that'll talk to us about it is Dave Lauer.
yeah, and like I don't even know how expert Lauer is, right? Besides his advocacy, which is awesome. Don't get me
Yeah,
wrong.
it seemed like
But
he,
like
15 years ago, he
I
spent a
don't feel
little
like
bit of
he's putting out
time.
any shit we don't already know, you know. So I'm not
No,
feeling like he's ahead of the curve from where we're at already. And I don't think we're I don't like to think we're that far ahead of the curve, even though we could be. But yeah, I mean,
I do
people
think
currently in the
that
industry are never going to say anything
I
because
do
you know
think that a lot
ruins
of the
their
big
chance of future
money.
employment. People out of the industry are locked in with non-disclosure agreements for forever. um,
Yeah. I do think a lot of the big money is not spending as much time as we are trying to look at the broader mechanics. They're more interested in just how their positions can manipulate the market in isolation.
yeah, yeah.
Um,
I mean, they're mostly just concerned with moving around their huge amounts of money safely, and not causing too many ripples. And we just want to ride the waves, right? Like,
yeah.
we're big wave surfers on these markets.
Next wave's going to be fun.
Yeah, I think that all these people who would be knowledgeable, yeah, they're either locked up by NDAs or they've been hired by Citadel, something like that. Because Citadel is the only group that I could think of that would really, because they've made so much money on basically what we're doing, right? They'd be the only ones that I
Susquehanna.
think would. I guess so, but not in the way that Citadel has with their order flow system and their
No,
massive
no. But
resources.
Susquehanna's huge, and they're definitely a part of this.
Oh yeah. I mean, I think that they work sort of in tandem. I mean, we sort of discussed, I mean, when you control 20% of the order flow in the market, in adding artificial inefficiency to price discovery in one direction or another or both can really benefit any funds that know about this inefficiency, right?
Yeah,
And that's why we see Citadel's gains so fucking high is because,
fucking unreal, man.
yeah,
Thirty-five
it's
point
insane.
five
It's
billion on 54. And like the market just never gets less advantageous for them.
Yeah, and that's really what gets my alarm bells going off, that there's a lot of collusion, potential collusion that could happen that would inflate your returns like this, right? And being able to, kill off demand for an equity, if only for just, 10 seconds while your fund moves into a big short position, can literally shift the sentiment on an equity like in a matter of
Yes,
minutes.
something's going on there,
We have drag, right? Don't
because
forget there's
there's,
drag.
they're not the biggest player by any stretch of the imagination, and these people are all very well equipped to deploy very complex strategies in the market, and they're all very much in lockstep competition with each other. So to have someone who's sort of in the middle or sort of an underdog just consistently outperforming big people in a way that's significant like this, right? I mean, if it's under $1 billion, nobody cares that somebody's come up with some super profitable thing. But they're at, these large players are at risk of getting beat by this underdog, and they're still doing well. Something's off, right? I mean, there's no way they can have that much edge over everybody else.
That much money too.
Yeah.
Like it's the returns, the returns on capital, like the notional returns and how much they're deploying. I mean, with that high of returns, that's really what gets me, right?
Assuming
It's not
adherence to a risk model, right?
exactly, yeah. I
Yeah.
mean, yeah, it's just it really throws me for a loop. Like someone has $1 million and they turn it into $20 million. That's kind of like whoop-de-doo. But when you're working with billions, it's a totally different ball game. So being able to be profitable like that is really insane.
Yeah, I agree.
It'll be interesting to
It's
see what they're up to when it all blows up.
Yeah, I know. I'm expecting them to blow up now because those returns are so crazy.
Eventually, I mean, maybe they just stop doing what they're doing. Well, no, that's not what they do. You just get
no.
greedier and
Oh
greedier.
no, it's gonna be
Yep.
hubris. Yeah, hubris is gonna get them.
Greed and hubris only compound.
I'm like, wait, yeah. Once you get over, a couple $1 billion and you still want more, I don't think there's anything that turns that off.
I don't know.
Here's where I know Kenny's safe. He's got the balls to just publish that and announce it to everyone, right? He's at the forefront of those articles, and like
Yeah, it's picture Ken
talk
Griffin,
about. And it's interesting too because Kenny has spent most of the last decade very much in the shadows until the GME thing, operating as much as he could behind the scenes. And now, he's making these big, bold statements, and I think he's getting ready to move Citadel towards banking and away from their current strategies.
Yeah, I think he wants to be a big boy more
Yeah,
than anything. More than money, he just wants to be a big boy.
more than money, he wants to win.
Yeah.
He just
He's a
wants old money to
fascinating
like
guy.
him.
All right, well, I think that's enough for today. But yeah, things are looking very interesting on multiple fronts. So we'll see how it all plays out. Thank you guys, everyone, for tuning in. Thank you, JFresh and Dork, for coming on. I always appreciate it, guys. Fun talking to you. We don't get enough time to do it in private, so
Yeah.
Thanks for having us on.
Yeah.
yeah,
Had a
absolutely.
great time. Looking forward to everybody dunking on me tomorrow when we drop below 15. So it'll be fun.
Yeah,
Oh man,
I'll be the first.
I'll just buy more.
Yep. All right, guys.
GMERQ, let's go.
Later.
all right, peace out.
All right, thank you guys so much for tuning in. Tomorrow morning I will start the stream. I will put out the daily DD, but I will not be here probably till like 10:30. I want to give myself at least that much window. Hopefully I'm back sooner, but I may not be. So I appreciate it, and I will see you all tomorrow. You guys have a great night. Pickles Picks will be out probably early tonight, actually. I don't think they're going to be very hard. I've been sitting on a few, so I think I have them mostly typed up. But thank you guys so much. I appreciate all the support from the members and from you poors watching along. And I'll see you tomorrow. Have a great night and enjoy the rest of your weekend.